right, let's begin with our exercises from chapter 12. The first one, number 1. All right, it talks about characteristics of stock, classes, and entry. So 72, a developer of radiology equipment has stock outstanding as follows. 60,000 shares of cumulative preferred 2% stock, $60 par. And 300,000 shares, $20 par common. So there's the two. So before we do anything, let's just figure out how much should preferred stock get, because that's who gets the preferential treatment. They're preferred. So 60,000 shares at $60 par. So you take on your calculator, 60,000 shares times 60, and then that amount times 0.02, the 2%. And that should calculate to 72 grand. All right, so during its first 4 years of operations, the following amounts were distributed as dividends. First year, 51, year 2, 105, third, 81, and fourth, 120. All right, so if we look at this exercise, and we just calculated that preferred is supposed to get $72,000 per year, we already are short in year 1. So all 51 grand is going to go to preferred, correct? All 51. It's cumulative preferred, so that means in year 2, when there's 105, the first thing we're going to do is take care of this year and the deficit from last year. So this year, current is 72,000, but we were short 21,000 from last year. So if you take 72 minus 51, that's 21. So the total of 72 and 21 will first go to the preferred, or a total of 93,000. 93 from 105 is this 12. So 93 will go to preferred, 12 will go to common. Year 3, there's 81,000, so of course 72 is taken care of. The rest, 9, goes to common. Year 4, there's 120 grand, so again, no problems. We got preferred taken care of. The excess, 48, will go to the common. And then what they did here is, you can tell, they calculated earnings per share. So there was 60,000 shares of preferred, so every year we calculated a different amount. As you can tell, in year 3 and 4, since they got exactly what they're supposed to, it will always stay $1.20. Common, because the amount changes every year, in this example, the per share, of course, will change. So we move to number 3, and it reads, all right, on January 22, this Jefferson County issued for cash 210,000 shares of $30 par common stock at $34. And on February 27, it issued for cash 15,000 shares, $9 par at $12. All right, well, so the first one, we record common stock at par. So common stock is the 210,000 shares at the $30. And in this case, they issued them for $34, so there's another $4 that's going to go to APIC, or paid in capital in excess of par. So 840 grand for the total cash of 7.14 million. On February 27th, they issued 15,000 shares, and again, we'll take it first times the par, $9, 135 grand. It was sold for 12, so there's another $3 more, which is going to go to paid in capital. So $3 times 15,000 is 45 grand, the sum of which is 180. In number 4, it's basically the same problem again. It's just called no par stock. So on May 15th, they issued 750,000 shares at $4. at $4, but they have a stated value, which essentially is like par, of $1.50. So we'll take all 750 times 150, and then the difference between 4 and the 150 going to paid in capital in excess of par. On the 30th, it issued 17,500 shares of preferred stock at $60. So $60, all 17.5 times 60, 17.5 times 50. The par is what we would credit preferred stock for. The difference between the 50 and the 60, or $10 times the 17.5, is what's going to go to paid in capital in excess of par. Number 5, it just talks about here where a company basically exchanges shares for land. So in this case, there was 14,200 shares given up for the land. So the land is going to be recorded at the fair market value, and it says the current market price of this stock was $34. So 14.2 times 34 is this amount, and again we're going to credit common stock at par, so 14.2 times $25, and the difference between the 34 and the 25 is going to go to additional paid in capital, or paid in capital in excess of par. Moving along to number 8 here. We got another problem here, and it just basically asks you to record these journal entries. And it says here they had 50,000 shares of preferred 2%, $60 par, and 1 million shares of $8 par common. Okay, so on February 5, issued 700,000 shares of common stock at par. Well, it says the common was $8, so 700 times 8 is 5.6 million. They issued 1,200 shares of common in payment of legal fees. So again, we'll take the 1,200 times 8. Common stock is what was issued, and it's going to go to organizational expense. On April 9th, they issued 40,000 shares of common stock in exchange for land, buildings, and equipment with fair markets, respectively. So let's record the fair market of the land, 120, buildings, and equipment. And they gave him 40,000 shares. So 40,000 shares times par, $8, is $320,000. If you were to add up your debits and your credits, it doesn't balance. So you can virtually say there's going to be another credit, and it would have to be the paid in capital in excess of par. Paid in capital in excess of par of $160,000. On the 14th of June, they issued 25,000 shares of preferred stock at $82. Well, we notice also that our preferred stock has a par value of 60, so we're going to credit preferred stock at $60 times 25 grand. There was a difference of 82 and 60, or $22 times 25,000 shares, 550. All of it is going to be debited to cash for $2,050,000. Number 9, again, it's entries for dividends. The declaration, record, and payment dates in connection with the cash dividend of $1,425,000 are July 9, August 31st, and October 1st. So basically we got the date of declaration, the date of record, and a payment date. Well, the date of declaration is when we actually record our liability. The date of record, there is actually no entry. What we're doing there is trying to figure out who owns what. So on August 31st, you don't really need to do anything. And then on October 1st is when we actually pay it. So we credit the cash and we get rid of the liability. That takes care of number 9. The next one I think we had assigned was number 14, and now we're starting to look at some treasury stock. And here it talks about this Mystic Lake bottles and distributes spring water. On July 9 of the current year, Mystic Lake reacquired 60,000 shares of its common stock at $42. On September 22, they sold 45,000 of the reacquired shares at $51, which is good. Brought it in at 42, we sold it at 51. And the remaining 15,000 shares, we sold it at 40, which is unfortunate. It's $2 less. Journalize the transactions on these 3 dates. Okay, so first, we purchased shares that were out there, which now goes into what we call treasury stock, and we purchased them at $42, credit cash. Then on the 22nd, we sold 45,000 shares. So what we do is this treasury stock is what gets credited, not common, treasury. And we credit it for what we brought it in at. So we don't necessarily, now this problem, it doesn't really tell you what the original par is. It'd be nice if they did that, just so that you realize that is not what we concern ourselves with. What we do is we look at what did we bring it in at, and that's what we credit the treasury stock for. Now we sold it for $51, so there is an excess there, which we will call paid in capital in excess of treasury stock, paid in capital from the sale of treasury. So the sum of those two is what we would credit to cash. On the 23rd of November, they sold the last 15,000 shares. Now look at here. We sold it for $40, so that's of course what we're going to credit cash for. But more importantly, those 15,000 shares are going to have to be credited at what we brought it in at. And we brought it in at $42. So we are crediting treasury stock for $42. We will debit the cash for what we got at $40. But rather than crediting paid in capital, we will debit paid in capital for the $2 difference times the 15,000 shares, or 30 grand. There's a good question, and it's in the reading, and it asks, say for instance, this transaction never happened, and we just sold some treasury stock, but we sold it for less than what we brought it in at. If there was no other, like we have in this case here, we have $405,000 of paid in capital, so this 30 can easily take some of that 405. But let's just assume that this didn't happen. Then that 30,000 can't be debited to paid in capital from the sale of treasury stock, but rather we will debit what we call retained earnings. Retained earnings would have to take the hit. Letter B, it says, what is the balance in this paid in capital? Well, of course, it's the difference between the 405 and the 30. And for what reasons might Mystic Lake have purchased? There could be a multitude of reasons. One, they've got the cash now. For what reasons might they have purchased the treasury stock? It says here, Mystic Lake have purchased the stock to support the market price, to provide shares for resale to employees, or for the reissuance to employees as a bonus. It can be a host of reasons. Those listed in letter C are also some of them. Then the last one that we're going to look at here is number 20. Number 20. All right. And that basically just asks you to do is a retained earnings statement. No big deal. So beginning retained earnings in this case was $59.65 million plus net income minus dividends. And in this case, there's two types of dividends, cash and stock. So a total of 3.6. So here we less dividends of 3.6 gives us our ending retained earnings of $64.21 million. So like we did in ACC 225, beginning retained earnings plus net income minus dividends, whether it's cash or stock, equals our ending retained earnings. All right, we'll stop there and then we'll finish the rest of chapter 12.